Hello and welcome to the Quality Investor. With earnings season in full swing, I will be providing commentary on some of my holdings as well as some market bellwethers. Today, however, I want to do a quick video on the insanity of the stock market. Now, the stock market has never been known as a place of sober analysis or cold irrationality. It really is manic depressiveness writ large for the world to see every day. What is happening now, though, defies even the most jaded and tempered investors such as myself. American Express, ticker AXP, released their earnings yesterday on Friday, October 20th, and it was a stellar earnings report. Yet, as you can see here in the market yesterday, they fell down to $141.57 per share, a 5.38% drop. Why would a company like American Express, with an incredible reputation, a premium customer base, have such a massive drop after record earnings? It feels like we're in a market right now that has no idea how to react to anything. News is coming from all corners of the world, most of it bad, some of it good, and the market just doesn't know what to make of it. And when companies release their earnings right now, even if there's the slightest bit of pessimism in those earnings reports, the market is punishing these companies very hard. So with that said, I want to dive in to the details of American Express's earnings report and see if that dip yesterday was very justified. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Join our vibrant community of investors focused on quality businesses. So how did American Express actually fare in this quarter? Well, we see here that their revenues, net of their interest expense, is up 13% year over year, and their net income is up 30% year over year. They also increased their diluted earnings per share by 34%. And they're also continuing their share buyback program. Their shares outstanding are now down 2%. However, this 58% number here, provision expense, and we'll get into this in more detail later, this, I think, is the impetus for the drop. We see here U.S. Consumer Services Build business, which is a segment of their revenue. Pretty solid, up 13% year over year for their T&E, and the GNS is up 8% year over year. But what caught my attention here is this: millennials plus Gen Z, year over year increase of 18%. This 18% growth is an interesting number to me, because we always hear about how millennials and Gen Z are going to get crushed with their spending once the student loans repayments get kicked back in. Now, granted, this is as of September 30th, these numbers. However, the CFO of American Express did state they haven't seen any demand decrease due to the student loan repayments starting again. So I interpret this as a green shoot. Here, card member loans and card member receivables credit metrics. This is a part of that story about that 58% increase in provision losses. We see 30 days past due, 1.2%. So 1.2% of their clients or their customers, at least 30 days past due on their credit card bills. And that's flat, not only from last quarter, but from the previous quarter in Q1. And it's below pre-pandemic levels. Here we have our net write-off rates. Now, write-off rates are not realized losses. They are a loss that is recognized on the income statement. However, it could be less, it could be more. It's just an estimate the company makes to account for potential losses. Anyway, Q3 2023, flat, 1.8%, flat from last quarter. Yes, it's up quite a bit over year. However, pre-pandemic, we're still below the pre-pandemic levels. Here's a breakdown of the revenue performance of American Express. We can see that their discount revenue, which is the rate they charge merchants to use American Express cards, is 55% of their total revenue. It's up 7% year over year. But that net interest income, what makes American Express different from Visa, for example, is they actually act as a bank as well as a card issuer. So they are also loaning money to the customer when a customer uses an American Express, whereas for Visa, they're just a network that processes a transaction. The banks loan the money for the Visa credit cards. Anyway, net interest income up 34%. That's a direct correlation with the increasing rates that we have seen throughout 2023. Looking at the growth plan American Express has laid out, you can see that they far exceeded their 2022 growth guidance, and they're on track. They're probably slightly behind in revenue growth for their 2023 guidance right now. However, they're on track to meet their 15 to 17% revenue growth in 2023, and they're certainly on track to meet, maybe even exceed their EPS growth for 2023. So the stock market is a forward-looking market, and they care about that growth. So a company that is exceeding their own expectations, as well as beating guidance from the Wall Street people, you'd expect that relevant increase of share price. But with American Express, we did not see that. And a lot of other companies, as earnings have come out in the last couple of weeks, have also seen pretty large declines in their stock price. Tesla. Though for Tesla, let's be honest, their margins are shrinking, and that is scaring the bejesus out of the market. However, once we take a look at the income statement for American Express, this, in my opinion, reveals the reason for that massive 5+% drop in their share price yesterday. So their revenue, net of interest expense, but not accounting for the provision for credit losses, it's up this year 16%, $44.7 billion versus $38.6 billion at the same period, a 9-month period of fiscal year 2022. However, you can see here their provisions for credit losses is up massively, over a 100% increase from the prior year in the same period. So $3.4 billion versus $1.15 billion. And that's what's driving down their margins and, I think, scaring the absolute crap out of the market right now. And in fact, it's such a significant increase that their entire net margin, it went from 20.6% at the same period of fiscal year 2022 to now 19.4% today. So that's 120 bips down. However, Wall Street is notorious for grabbing a single piece of information and completely running with it, panic selling all over the place over the slightest bit of fear. So we're going to dig a little bit deeper on these provisions for credit losses and ask the question, is it that bad? Provision for credit losses is an estimate a company makes of how much they think they will not collect from their account receivable or loan proceeds, for example. So on the surface, when we see a big jump like this, $3.4 billion from $1.15 billion, an over 200% increase, that's going to scare some people because it looks like they're estimating they're going to receive a lot less of what they have lent out to their customers. So we see here their breakdown of the provision for credit losses, and here's that $2.6 billion number from the income statement for the loan portion of the provision, up from that 757 from the last year. However, looking at this, it's not up that much over quarter, just a slight 0.2% increase from the previous quarter. And it's actually a smaller percentage of the past due loans right now from American Express than it was last quarter and last year over the same period. My point in all this is, despite the provisions for credit losses increasing quite a bit, they've also increased the amount of loans they've given out, which means they're increasing the amount of interest they're receiving for those loans and at a higher interest rate. So it does look bad. However, digging into the numbers a little bit, there are some silver linings there, shall we say. The card member receivables is a similar story. However, there's even more silver linings. Look at the 30 plus days past due. Lower quarter, and the exact same year. Yes, they did increase their amount, but they also increased the amount of receivables they have. And the percent of receivables for credit losses here is even less of a percentage than last quarter and the same as year over year. there seems to be a narrative forming that consumer spending is going to fall off a cliff, especially with all this student loan repayments having to start up in October. But the numbers aren't bearing out such a stark reality. It's not a great reality, but the numbers aren't bearing a stark reality. For example, the net write-offs on the consumer services segment of the member loans, 2.2. At Q1 2023 was 1.9, a 15% increase. Okay, so 1.9 in Q1 23 versus Q4 22 is of 1.3 here. That is a 46% increase. Any sort of pain has already been baked in to American Express's numbers here. Another set of numbers that demonstrates this, in my opinion, is the return on average common equity. We see here at Q3 2022, 33.6% return on average common equity. Q3 2023, 38%. They're increasing the return on average common equity, which is a metric banks typically use. However, American Express does the lending. They are the issuer, so we have to track them as if they were a bank. However, this further illustrates my point that there was some pain between Q4 2022 and Q1 2023. However, they're now expanding their returns. The last set of numbers I want to look at is net interest yield on average card member loans. They've increased their adjusted net interest income to $3.4 billion in this quarter, up from $2.6 billion a year over year. And this is another stark reminder that American Express is receiving more in income here. And that's 11.7% interest yield on their card member loan, up from 10.8% a year ago. Of course, that reflects the Fed's increasing of interest rates, and of course, that's going to trickle down through any sort of lending business. However, with more loans outstanding, 116.6 versus 97.7 a year ago, and a higher interest rate, that's more income for American Express. And ultimately, that flows down to the bottom line with a diluted earnings per share of $3.30, a banger number, way up over the $2.47 they reported a year ago. In my opinion, a great quarter for Amex, and the market is certainly in a sour mood right now, overreacting to the slightest negative news with each company with panicked sell-offs. Okay, before we go, I want to emphasize this is not financial advice, and I do not own shares of American Express. The Amex fall on Friday is a proxy for the panicked markets right now. Is Amex suddenly 5.4% less intrinsically valuable because of credit loss provisions? I don't think so. With that, thank you for watching today's video. And what do you think? Has the market gone completely insane? Let me know by commenting below. I do love the feedback. Also, please hit that like button. And if you found this info helpful, subscribe to the channel and join our community. Thank you and happy investing.